Hey gang, welcome to Time in the Market, the investing channel with a long-term focus, taking a look at another specialty retail play. Hey, that's two in a row, ticker ULTA, ULTA Beauty Inc. Obviously, these guys are in the beauty space, cosmetics, fragrance, etc., that sort of stuff. Stock is down about 18% in the past month. And again, similar to Lululemon, they're seeing slowing growth, pressure on the top line. And really, in the past week, their CEO was on a retail conference with JP Morgan and talked about how the first 2 months of the year are a bit lower than expected in terms of sales. And they already expected slowing growth in Q1 and Q2, and then growth picking up in Q3 and Q4 to kind of get to their target. And now the question will be for investors whether or not those targets are a bit optimistic given what the CEO said on that conference regarding slowing foot traffic in their stores. But even though the stock is down about 18%, you go 6 months out, still up about 16%. This is a stock that was at 380 just a couple of months ago. So it doesn't necessarily mean it's an amazing valuation today, but it's certainly getting closer to it because this is an interesting store. Good margins, good free cash flow, relatively good use of funds to buy back shares. We'll talk about that in a second. Looking at their last earnings release, sales were up about 10%. That does include a 53rd week. So, closer to 8 to 9% without that. But the problem is that comparable sales still up 5 to 7%, but slowing from 15.6% the year before. So really slowing growth here. At the end of the day, the margins here are solid though, 15% operating income margins, but down a little bit compared to the year ago. Free cash flow margins still really good at 10%. And this is one of those retail plays where the margins are in the low teens, kind of like Lulu being in the high teens, much higher than usual. A lot of these retail margin plays are 2 to 3% when it's like a bigger player, getting into the mid single digits when it's more of a specialty player. So seeing 10% margins and above is really good, especially when in the case of ULTA, you're not really producing most of the items that you're selling. They do have some private brands that they produce themselves, but at the end of the day, most of the stuff they sell are other brands. So having 10% margins on that is pretty solid. Balance sheet, really, really good. What they've been doing with the free cash flow that they do generate is buy back a lot of their shares. That's the primary use of their money there. Obviously, they're opening a bunch of stores, improving their stores, but beyond that, that's post CapEx, free cash flow generation. They had a $2 billion share repurchase program started in March 2022, used all of that up by 2024, reauthorized another $2 billion just last month, March 12th, 2024. And I think you're basically going to see about $1 billion in stock repurchases every single year as long as they are generating free cash flow and as long as they feel like the stock is fairly or less than aggressively valued. The question here is going to be, this is a purely US play at the moment. They already have 1,400 stores, opening up another 60 to 65 in the next year. How much growth can they get out of this business model in the United States? The growth is slowing, only 4 to 5% growth in 2024, down about from 9 to 10% in 2023, down from 20% in 22, 40% in 21, and really solid growth outside of the pandemic. And growth expectations are kind of coming down into the mid to low single digits and might be even lower this year if what the CEO said during that conference comes to fruition and it doesn't pick up before the latter part of the year. So there might be some pressure on the stock price. Again, balance sheet here, really solid, talking about no real debt, some capital leases obviously, but at the end of the day, cash on the books is good. No real concerns around debt from a cash flow perspective, generating about $1 billion a year, using most of that to purchase back shares, and really just going along from a valuation perspective. This is a stock that's kind of hanging out in that 5 to 6% free cash flow range on a next 12-month basis, about 5.3% right now. The highest it's been in the last year or so is about 6.3%. So it's not as cheap as it's been about 6 months ago, but it's certainly at a reasonable value, about 5 to 6% free cash flow yield, depending on how you look at it. Pretty solid. If you look at the marketplace they're in, it's pretty fragmented. It's about $100 billion beauty products market that they're competing in. This is from data in April 2022. So it's obviously potentially a bit higher right now. And specialty beauty, of which ULTA is a part of, is only about 15%. And when you talk about specialty beauty, Ulta is more of a mass market specialty beauty player, really competing on the low end all the way to the high end. Their other competitor in this space is Sephora, owned by Louis Vuitton. Those guys really compete in the high end space, really more of an experiential play, whereas this is more of a mass market play. That's kind of the difference. Sephora, from what I've read, kind of has a better experience, but obviously the price point there is much higher. Ulta, maybe slightly worse experience, but really fantastic rewards program. They have 40 million, almost 40 million rewards members right now. Their rewards program is almost too good, but if they can, from what I've heard, it's really good. But if they can maintain it while maintaining 10% margins, I'm all for it because that attracts people to their stores. What it allows them to do is basically allows them to sell cheaper products at prices that are higher than some of the competitors, but draw people into their stores with that rewards program. So that kind of offsets the margins that they may be losing out on the rewards program itself. If you look at the distribution of beauty products, though, a very competitive marketplace. You may see it's only Sephora and Ulta, but not really. They're competing with Costco. They're competing with grocery stores. They're competing with Amazon. They're competing with drugstores like CVS because people buy a lot of this stuff, whether it's hair care, skin care, cosmetics, fragrance, bath, etc., in other areas. The question is going to be, how can they grow this piece of the pie? How can they steal market share from grocery stores, from e-commerce, from mass club and variety stores, from drugstores and department stores and direct selling, etc.? That's the question, because this is not a space that is growing to grow at a massive clip. From the data point here from Statista, the market is only projected to grow by about 2.4% annually. So that's not a huge amount of growth. Yes, it's going to grow, but it's only growing at about the pace of inflation for the next couple of years. And I don't know if I expect that to change. And again, this is the market in the United States. Obviously, this is a United States only company. There is some upside here if they expand to other markets. If you think about the markets where beauty is a potential for high returns, you're talking China, you're talking Japan, Germany, France, Italy, etc. I think their next market that they plan to expand into is Mexico, and I say next when I mean first. And that's an interesting choice to make. I think they're going to do that via a partnership with some company there. They were planning to expand into Canada prior to the pandemic, but obviously the pandemic put a halt on that. Don't know if they're planning to restart those expansion plans in the future. But again, going into other markets, it's sometimes a difficult thing to do. For example, Target tried moving into Canada, completely failed. Can Ulta move into Canada and do a good job there? Can Ulta move into Mexico and do a good job there? Can they move overseas into non-adjacent markets? I would love to see a company like Ulta in Japan, in Germany, in China, markets where beauty expenses are growing and high, where they could really rev up their revenue. That is the question. The question is, what can they do? What kind of things can they do to appeal to some of these shoppers that are spending 85% of their money on the beauty and personal care in other channels? Because that's really what they're going to have to do. This market itself is not growing fast enough for them to grow without taking more of this market share. It's large and fragmented, which is a good thing because you can take more market share away from other companies, but it's also a bad thing because it's very competitive. Costco is probably going to offer some of these things that Ulta offers at a much lower price point. You can kind of go here and see exactly what it is they sell. 42% of their stuff comes from cosmetics, 21% from hair care, 17% from skincare. They talk about the variety of price points, things like CeraVe, things like Neutrogena. When I go to Costco, I see some of that there. You're competing with places like Costco. You're competing with places like CVS. It's very easy to just pick up, some lipstick or whatever at a place like CVS. You won't have the variety of things, and you probably won't have the experience that you have at a place like Ulta or a place like Sephora if you just buy things at Costco or CVS. But if you're a person who only uses beauty products here and there, why go to a place like Ulta? They talk about how their target customer is the beauty enthusiast, how that's only 66% of their shoppers, but 83% of their dollars, because people spend more money if they're into beauty products. The question is, how do they convert these non-beauty enthusiasts into beauty enthusiasts who spend more money at their stores? And they talk about some things that they're doing. They have services in their stores. They can bring people in to get a haircut or a facial or a hair color, and those people will buy more money. They are kind of supercharging guest acquisition via their Target stores because more people go into Target than would specifically go into ULTA Beauty. But once they experience ULTA Beauty there, they might go into the store itself or just continue shopping at ULTA Beauty via Target. And they do other stuff as well. They have a best-in-class loyalty program. Again, 40 million members. Pretty freaking impressive when you talk about that's what 12 to 13% of the population in the United States. Other stuff, obviously the service at a place like ULTA is going to be better. But if I was an investor in a company like ULTA, I would want to see what this store is about, talk to people who shop there, go into the store, see what the experience is like, etc. So as I look at the valuation, keep in mind I haven't done any of that. Before I would do that, I would do something like that. This video, again, is purely for informational, educational, and entertainment purposes only. It is not investment advice. So as I look at the valuation here, 4.8% free cash flow yield on a last 12-month basis, 5.3% on the next 12-month basis, kind of assuming mediocre growth on a go-forward basis. That's kind of my assumption here. You can kind of see the estimates from the market is kind of 5 to 7% growth in the next couple of years. I'm going to take that down. Even though they said 4 to 5% growth for 2024, because of what they said during that retail conference, I'm going to take it down to about 3.5% and then about 4 to 3.5% growth for the next couple of years. Margins remaining steady at 10%. That worries me a bit when you talk about a company like ULTA having 10% margins. Can there be pressure on those? You know, as other competitors move into the space, what if Costco gets more aggressive in their beauty program? What if people start kind of cutting back on their expenses and they realize that they have to move down to the lower price points of the beauty stuff that they use, and they realize that the stuff costs more money at ULTA than it does at CVS? That could be a problem for a company like ULTA, who knows that they have to make up the margin that they lose on the rewards program by charging more for some of the stuff that you can buy it cheaper at a grocery store, for example. And obviously, as people spend more money on other things, on necessities, a company like ULTA might suffer. And I think that's why the market is trying to take this and judge it a bit more conservatively, because they're worried that if we go into a recession, a company like this, a company like Lululemon, all of these discretionary expense stores are going to be hit really hard. Now, the thing I like about this company, balance sheet is really good. They do generate free cash flow. Even if they start shrinking in terms of revenue, I think their margins can be sustained. They can probably cut back on some of their store openings, et cetera, and continue generating free cash flow. So I'm not worried about a company like this going out of business. It's a matter of how much further can they grow? How can they take market share from some of those other players? Because there's still plenty of room to grow. And that's only talking about the United States. If the expansion to Mexico is successful, if they move into other markets, a lot of potential here. The question is, when does that happen? How does it happen? How well does it go? So for now, I'm just assuming relatively reasonable growth that maybe is 1 to 2% higher than the growth of the overall market based on these expectations from this study here. And then margins remaining relatively steady, and most of this cash going into buybacks. So I'm expecting about $4 to $5 billion worth of buybacks in the next 5 years. Again, kind of in line with what they've done in the last 2 years, in line with what their share repurchase program was. Right now, they're getting about a 5% free cash flow yield. I think that's relatively reasonable. You can kind of be more or less aggressive. You can play around with the spreadsheet file, make a copy. I will leave a link in the description down below. 5% free cash flow yields about a 4% return on a free cash flow basis, but I think what's driving the return here is the buybacks that they're doing. You're talking about a 4% buyback yield. If you kind of think about their $21 billion market cap and $4 to $5 billion in buybacks in the next couple of years, they could potentially buy back 20% of this company if the stock price doesn't go up a lot from here. If the stock price kind of sticks around here, maybe goes up a couple bucks, a couple percent every year like it would here, you're talking about buying back 15% of the company, even with 5% growth on a price basis alone. So as I look at this here and I look at about a 10% target return, gives me a fair value of about $418 with relatively conservative assumptions here. Seems like it's not too far off the mark. If you're a bit more aggressive about this company, if you feel like they have room for expansion, if you feel like this is kind of a dip that's going to correct with growth in the future years, if you feel like they can expand margins, certainly you can look at a free cash flow yield of about 4%, which leads to about a 12% total return. about a 79% price return, 12% a year total return, and a fair value of about $500. So obviously some upside for you there if you're a bit more conservative here. Some of these specialty players are getting a 5 to 6% free cash flow yield with the market today. With that in mind, you only get about a 5% return from here, a fair value of about $364. So it's kind of up to you to see where you feel comfortable with this. For me, I don't love this company enough to really get excited about a 10% return here. I think I'd be closer to a 12.5 to 15% return here, which kind of brings me to a price point in the 370, 340 range. So if this stock kind of tanks and kind of goes back to where it was just a couple of months ago, I should have looked at it back then because I probably would have been more interested in it then than I am now. In that 380 range or thereabouts, I'd be interested in it because this seems like a fair company. And this is me saying it's a fair company without knowing enough about it. I'd have to know more about it to judge it as a good company. Seems like a fair company at a fair value right now. In the 418 range, it'd be fair company at a pretty good value. In the 380 range, it'd be a fair company at a good value. And then in the 330 range, it'd be a fair company at a great value. So that's kind of how I feel about it. Am I buying it right now? No. Am I going to put it on my watch list and learn more about it in the coming months and kind of look out at a sub $400 price point? Yes, I think that's where I am now. From today's price point with these assumptions, I get an expected return of about 8%. Not too terrible. 8% from today, not too terrible if you're a shareholder or if you're buying right now. I sort of get why you're doing it. This seems like a reasonable value, a reasonable company, but for me, I'd probably want a bit more in order to add this to my stable of stocks. I don't think that these stocks are going to run up anytime soon. I think there's probably more risk to the downside in the next couple of months with companies like Ulta or Lululemon than there is to the upside, because all you need is some earnings announcement that shows shrinkage in margins, that shows further degradation in growth, and you can have these stocks move 15% down really easily. Obviously, the reverse could happen, but I think there's more risk on the downside with where customer spending is right now. People are struggling to make ends meet. Groceries are expensive. All of the things in life are expensive. So to go out there and say, I'm going to get, a huge collection of makeup, probably a struggle for a lot of people, where maybe that wasn't a struggle 2 or 3 years ago when the pandemic was kind of over and some of that money supply was really going up and people were spending freely. Now that's coming back down to earth. Now, the good thing is that this valuation isn't ridiculous. Like if this was a 3% yield with growth slowing to where it is now, that'd be a problem. But since it's already in that 5 to 5.5% range, not too bad. If you look at this a couple months from now and it's in that 6% range like it was back in October, would I be interested in this? I think so. Let me know what you think. Leave a comment down below, like, subscribe, etc. As always, not financial advice, guys. Please do your own due diligence. I am not a financial advisor, but hope you enjoyed the video. Let me know what you think. And if you want me to do any specific companies, leave a comment down below and I will try to look into them. Thanks for watching. Have a good day. Bye.